Today, we're totally redefining how busy executives like you approach investing. We're going to stop treating the stock market like a daily casino, right? Instead, we're applying the rigorous, uncompromising mindset of a corporate acquirer to build a portfolio of really durable cash-generating assets. Let's dive in. So think about this for a second. What actually separates a volatile stock gamble from a true forever asset? At the office, you evaluate business deals with immense scrutiny. You know the drill. You run the models, you check the debt, you analyze the competitive moats. But then, personal portfolios are often just left to chance or passing trends or whatever the market happens to be doing that day. Today, we're challenging that disconnect. We're going to build a true acquisition-grade framework for your own capital, so you can buy assets that actually do the heavy lifting for you. Here's our strategic roadmap for today. 1. The executive acquisition mindset. 2. Deconstructing business value. 3. Capital structure risk profiles. 4. Avoiding permanent capital loss. And 5. Building the forever portfolio. Section 1. The executive acquisition mindset. Moving from gambler to capital allocator. Section 2. Deconstructing business value, the micro-model case study. To strip away all that corporate complexity and really expose the raw mechanics of an acquisition, we're going to use the absolute simplest business imaginable: eliminate stand. Just watch how this 5-year trajectory unfolds. We start out in year 1 with a single stand generating $800. Now, instead of paying out dividends to ourselves and calling it a quick win, we relentlessly reinvest every single dollar of free cash flow right back into the operation. By year 2, boom, we have 2 stands. Year 3, economies of scale start to kick in, fixed costs are distributed, and our margins naturally expand. Fast forward to year 5, and this ruthless reinvestment strategy gives us 7 stands and nearly $8,000 in revenue. You see, this isn't just linear growth. It's the exponential power of scaling at work, taking one single asset and turning it into an automated revenue engine. And look at how cleanly the math maps out by year 5. Over on the balance sheet, our assets have ballooned up to $4,000 against a super manageable $250 in original debt. Meanwhile, the income statement is showing over $7,900 in revenue dropping down to $1,500 in pure after-tax profit. The asset is now compounding value completely effortlessly, totally independent of the founder's daily labor. It went from a hustle into a self-sustaining corporate entity. And honestly, that is exactly the dynamic you want to acquire. Now, you might be wondering, how did we find that initial launch without just totally choking the business on debt? Well, we sold a 33% equity stake for $500. Yeah, the founders diluted their ownership down to 67%, but they traded a piece of the pie to ensure the pie actually got baked, right? We fueled growth while keeping the balance sheet absolutely bulletproof. In the executive acquisition world, understanding exactly how an asset was historically funded tells you pretty much everything you need to know about its underlying financial health and future resilience. Moving on to Section 3, Capital Structure Risk Profiles, Debt versus Equity Mechanics. In any acquisition, you have got to understand your exact position in the capital stack. Let's break it down. A lender holds a senior claim. They're asset-backed, taking on way less risk, but their return is strictly capped at their interest rate, say 10%. They get safety, sure, but absolutely no exponential upside. Equity holders on the flip side sit at the very bottom with a residual claim. You literally get whatever is left over after everyone else gets paid. The risk of total loss? It's incredibly high, but in exchange, your upside potential is practically infinite. As an allocator, managing that specific risk-to-reward ratio is basically your primary job, deciding when it makes sense to play it safe and when to go capture that residual upside. Section 4. Avoiding permanent capital loss. The math of preservation. Protecting your capital mathematically trumps chasing high-risk gains every single time. $25 million. That is the staggering, almost unbelievable power of uninterrupted compounding. If you invest a mere $10,000 at a 20% return and just leave it alone over a 43-year career, this is exactly where you end up. It's crazy. The math just works tirelessly in the background, doubling and redoubling your initial capital without you ever lifting a finger. But the second you introduce volatility, the math turns completely ruthless. If you take huge risks to chase those returns and suffer just one 50% catastrophic loss every 12 years, that beautiful $25 million portfolio collapses down to just $1.8 million. Why? Well, it's simple math. A 50% loss requires a 100% gain just to get back to zero. You literally have to work twice as hard just to break even. Permanent capital loss completely destroys the engine of compound interest. It breaks the chain, and it forces you to restart the clock on your wealth. This brings into really sharp focus Warren Buffett's famous maxim: rule number one in investing is never lose money. Rule number two is never forget rule number one. For an executive building a portfolio, avoiding that fatal strike, the permanent wipeout of capital, has to be your absolute highest priority, way above maximizing annual yield. You can survive a slow year, but you cannot survive a zero. Preservation is the absolute foundation of the acquisition mindset. Finally, Section 5, Building the Forever Portfolio. The acquisition filter. To actually build this portfolio, your first non-negotiable filter is capital intensity. Simply put, this is the amount of cash a business just bleeds into physical assets, like factories or machine tools, just to maintain operations and stay competitive. Think about a legacy auto manufacturer forced to dump billions into new factory tooling just to keep the lights on, versus a low-capital software or beverage company that scales with minimal physical drag. High capital intensity constantly starves the equity holder of free cash flow, and we definitely want to avoid that. The absolute pinnacle of low capital intensity is what we call the royalty advantage. The very best businesses on earth act kind of like toll bridges. Think of the American Express or Coca-Cola models. They're earning a percentage on transactions or franchise networks that were built on other people's capital. They generate massive, highly scalable cash flow without bearing the burden of heavy physical reinvestment. When you acquire a piece of these companies, you aren't just buying stock, you are buying a pure compounding machine. So here is your personal M&A mandate. Think of this as a rigid checklist to filter out the bad deals and secure those forever assets. First, demand liquidity through public markets. Second, require a simple, easy-to-understand business model protected by deep structural barriers to entry or moats. Insist on low capital intensity and strong brand loyalty that gives them real pricing power. And crucially, seek assets resilient enough to be immune to extrinsic macro factors, things like wars, supply chain collapse, or interest rate spikes. If a business needs perfect macroeconomic conditions to survive, it simply does not belong in your portfolio. Take a hard, uncompromising look at your current strategy. Does your next major acquisition truly pass the forever test? Transitioning your mindset from a casual market participant to a ruthless capital allocator could literally be the single most important strategic move of your financial career. It is time to start acquiring assets that actually match the rigor of your executive standards.